to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Joining me and my colleague Chirag today is Mahesh Patil. He's CIO at Aditya Birla Life AMC. Welcome, Mahesh.
Thank you.
You began your career as a computer engineer before moving into finance. So if you could share with us what sparked your interest in investing.
Yes, you're right. I mean, earlier, I think when I was a student, I think aspiration was to be an engineer, right? Either you had two fields, either be an engineer or a doctor. That's what it was in the late 80s. And but I think somewhere down the line, at home, my dad, he was an early investor, right? Though being he was a government servant, but he had some investments, okay, in some of the blue chip company, MNC company. He kept talking about how those investments have really paid off, how they were giving him good dividends. But I think later, when I was pursuing my MBA, right, this was in 1992, yeah, that's the time when India really got into the whole phase of economic reforms, right? And and that's the time when also we had the Harshad Mehta bull run, right? So that's something which I mean that was a period, exciting period, right? When you saw a huge interest, how quickly you could make money into the markets, and that to some extent sparked my interest in the field of stock market. I mean, finance was something anyway as a stream which I was planning to pursue during my MBA. But I think that initial tryst, okay, with the markets, okay, when you were actually participating in the market and possibly enjoying the kind of a fun or the action over there, really got my interest into that area. And then that's where I think that's the time when equity research was just kind of emerging as a field. And I thought my strengths as an engineer, the analytical skills, I think they were more suited towards pursuing that career. And that's how I started really looking at the stock market, but more importantly, as an equity research analyst with one of the domestic firms. That's how I started my early career after my MBA.
Sir, if you look at it, then it's been around 3 decades for you in the financial markets. What are the biggest changes which you have witnessed compared to now and compared to the 3 decades ago?
So I think we've seen a big evolution in terms of the capital markets, right? In that era, there was the information availability was really not much. There was an asymmetry of information which was there. Again, the markets were not as deep, right, as at what we have currently. The regulations, okay, big was on regulations. We didn't have too many regulations, okay, which were really driving in terms of okay what you could do. So I think clearly on a regulatory front, there is a big evolution, I would say. I mean, the SEBI, this thing was established in that after that, and then we saw all the regulations on the securities markets coming into play in that time period. Market depth, and that time it was more about just about physical shares was still the kind of an era, right? We didn't have demat shares. So there was a big process in terms of getting the shares. Okay, once you buy the stock and then getting it converted in your name. So I think all that execution hassles, procedure, and on regulatory side has seen a big change over there. But from an investment professional, from investing side, I would say that the availability of information that time it was really restricted. You need to really have a one-on-one interaction with the company. You have to really take a lot of companies on face value what they were saying. There were very few other media where you could really collaborate that information. So that has really changed. Now there is a lot of transparency in information. There are multiple sources of information where you could get the data and try to really collaborate with what the management is saying. There are a lot of now research, external second research, which is available on companies. And so I think the democratization of data, which has happened, I think is one of the big changes which is there. And obviously the participation, right? So we are now seeing multiple players coming into the markets. There's much deeper market participation. Earlier, the markets were much thinner. So so a lot of stocks could actually get rigged up, right? If there's some large institutional player who came into the market. So yeah, I think there's a sea change, I would say, in that period, and I think for the good, I would say. I think in India, I think Indian capital markets actually have evolved, I think, much faster, I would say, and we are now comparable with some of the other developed markets in terms of regulation, in terms of the practices, in terms of disclosures. And yeah, so now I think in the market, it's no longer information, right, which is an edge. Earlier, if you had some information, that was an edge. Now, information is available to everyone at the same time, right? Even a retail investor now can get all the information about the any con call which the management does. The transcripts of that is now supposed to be disclosed in the public domain. It's more about analysis, how do you use the information, interpret the information, and take those calls. So I think that is more critical now, right?
Right. In your early days at Parag Parikh Financial Advisory and Motilal Oswal as the research analyst, what were some of the key takeaways that have shaped your approach over the years?
I think that grounding in research, I mean, those were the early days of equity research and working with some of these funds, which were really doing hardcore research, really helped in terms of how to, analyze companies, okay, how to build models, but also getting deeper into the sectors. So, so the foundation in terms of, and again, in those days, it was fewer companies, okay, which one were tracking. So there was much more deeper, and you had more time in terms of analyzing a company. So I would say that asking the critical questions, the depth, I would say, the depth of research, which is critical. Sometimes nowadays you tend to do it much more superficial. That time we have to build our own models from scratch. And when you do that, from the looking into the balance sheet, looking into the annual report, so reading the annual report, which is now very few do that, that gives you a lot of insights in terms of how the company has been shaping up. What are the kind of manage? I mean, the accounting juggleries. Okay, some of the companies were doing. Okay, when you really go through the financial statement detail line by line, I think all that grounding in terms of trying to look at the granular details, I think that really shaped. Which carried forward. Okay, later on also as when I moved into a fund manager. So I think that grounding in research in some of these firms, okay, which were known for good quality equity research, really played the foundation, okay, for analyzing and then helping me as a portfolio manager down the line.
So coming to the Aditya Birla Sun Life Mutual Fund, you have been with this fund house for nearly 2 decades or so, rising from a fund manager to a CIO. How has this journey influenced your investment style?
So, initially, okay, when I joined, it was more about, it again also depends on the phases of the market, right? So when I joined here in 2005, okay, we were in the kind of a midst of the big bull market, right, which started. So at that point in time, there were a few sectors which were doing very well, like the capital goods sector, the infra sector, and that's a time where, and these are the sectors which are area of my strengths, because as a research analyst earlier, and even telecom for that matter, were sectors which I was looking at. So it was easier for me to really get in quickly based on the strengths, okay, which I had in a few sectors, and I could do well. But after the global financial crisis, right, when we saw the sharp meltdown, okay, that's where one realized that, okay, you need to have a good understanding, okay, not only of few sectors, but also a good, not only bottom up, but a good macro understanding. Because again, who would have thought that, the global financial crisis could lead to a similar kind of a drawdown even in our markets, right? So that's when you realize that all the financial markets are correlated and linked. Anything happens, anybody sneezes in other markets can impact your markets. And understanding the macro is equally important for you to really kind of manage the risk in a portfolio, to calibrate risk depending on the macro. So I think a lot of emphasis went after that in terms of understanding the macro, understanding what's happening globally, how global liquidity, how global risk can influence our markets. So that's another, that's one area really which we worked upon. and try to build various models to look at the macro part of the whole research. And because of the shocks, okay, what we got fairly early, right? I mean, and we've seen the big kind of a drawdowns and how it could impact your portfolios. I think what clearly came to, at least from our, at least when I was kind of heading the investment function, was elevated. First focus was on risk management. How do you build up a risk framework, okay, so that you are able to withstand some of the shocks? And that's where we've looked at the risk framework in terms of what are the risks, or the or designing the guardrails, okay, what we need to have in a portfolio. So we came with a framework in terms of what is the active risk, okay, which fund manager should take in a portfolio at a stock level, and even at a sector level vis-a-vis the benchmark, and work within that framework so that you are not taking excessive risk. Because we've seen that in the earlier bull runs, even during the dot-com crisis, okay, when I was not here in this firm, but we've seen that very large exposure in a particular sector or stock because it was doing well. Okay, when the sector started to underperform, it was very difficult to really exit or move out of that, and that led to a large volatility. So that's another big learning, I think, in terms of having a good risk management framework, and working within that framework was a big learning. And we put that framework in place in somewhere in 2011-12. And over a period of time, I think uh, uh, the style, I think what I've seen is that Indian markets is it's a growth market, right? India has been a growth economy. There are a lot of sunrise sectors, okay, which are emerging. And as a style, I would say that I mean, we've decided that, at least I, over a period of time, that growth is where you want to, that's going to do well over a longer term in Indian markets. And at the same time, also trying to be slightly conscious about valuations, because I have been ingrained, okay, as I said, in the equity research, so valuations were also important. So GARP as a philosophy, which is growth at a reasonable price, is something which really shaped our overall investment philosophy as a fund house, okay, in that journey. And that is what we are probably known for. But at the same time, over a few years, we've seen that with the GARP philosophy, at times, especially in a market where we've seen um, in 2019-20, where we saw growth at any price, a lot of growth stocks did very well. So we again recalibrated that and trying to look at some of these high growth companies. How do we look at those, right? Some of the new age companies, okay, which are coming in, trying to build up a framework so that we can participate them, and while still sticking to our philosophy. So yeah, so I think there have been a lot of learnings. I think every market correction or this thing is a learning phase, right? I mean, that's how you learn in the capital market, right? You make mistakes, you learn from those mistakes, and try not to make those mistakes again. And yeah, it has been a journey which, hopefully, I think as you move in the period, you make less mistakes, and then you create your own philosophy, really, right? In terms of what you want to do, what you don't want to do. So that, I think, has clearly evolved over the last 20 years.
Right. And 20 years is a very long time indeed. So what makes Aditya Birla Sun Life AMC special enough to keep you here for so long?
So I think one is clearly, I think, the industry itself, right? It is always keeps you on your toes, right? So this is I'm fortunate to be in an industry where you're always there's always, every day when you come, okay, there's some kind of thing out there. There's always excitement which is there, right, for you to really touch forward. And so that is what I really love. Okay, what one is doing on a day-to-day basis. It gives you is given a good platform, right, for me and even for the other employees to be able to, with the brand name, to be able to interact, to meet any management. And so I think the group itself, in terms of policies for development, right? One is your own development into your professional area, but also overall development. I think the Aditya Birla Group has got wonderful philosophy for people development, for grooming leaders, which I've seen in very few family-owned businesses. So that has again been a reason for me to stay back, because they know how to take care of the employee and to really groom them to take higher leadership roles. But I think more importantly, I think working as a team, right, in the investment, it's about the team itself, right? So because you are dependent on each and every one, right? In the investment function specifically, it's a very small team, right? Each one has a very defined role to play. Analyst has a defined role for looking at the sector. The fund manager has his clear role. Dealer has his role. So how do you work as a team? And the kind of trust and the camaraderie which you build within the team really gets you going, right? So I think I was fortunate enough to have a good team. I mean, when I joined in here, in the next 2 3, there's a lot of overhaul which happened, and there was a lot of people who joined us at that point in time, and many of them are still there with us. So I think the team spirit, the team bonding, and this thing is one of the most important factors, okay, which not only creates a good working environment, but it also helps you to really build the trust, because within the team, right, because you're dependent on each another for some of the ideas. So I think that is one of the reasons. And the team which we have it's a great team, and it's been there steady for long. We have some few changes, but it's only grown in shape and size, and that's one of the key kind of a bonding, okay, which has really endured over a period of time.
Sir, how would you describe your investment philosophy, and what are the conditions or the styles of the market which you like, or the stocks which you favor the most?
So I would say my investment philosophy is, again, as I said, GAR, right? Growth at a reasonable price. So essentially, we are looking to buy companies which we think can grow faster, right, than the economy, right? Nominal growth in the economy, or more importantly, within the sector, right? So a company which is growing faster than the industry is doing something different, right? They are able to gain market share either because they have got some kind of a moat in the business, right? They have some competitive advantage which is there, it can either come in from a strong brand, it can come in because of cost competitiveness, it can come in because of a distribution strength. So some kind of a strong moat needs to be there to able to grow better than the other peers, and also doing it profitably, right? So one is growth. You can grow, but it has to be a profitable growth. Where I mean, when I say profitable, means I mean it should be minimum over a cost of capital, but that's not good enough for me. It should be at least say 15% or more return on capital. I mean that's the lower, ideally 20% or higher, because that is how company is utilizing the capital efficiently. I think is very important for long-term wealth creation, and then focusing on cash flows, because it's also important. I mean, that's over a period of time when I realized that cash flows are what really drives the real profitability, or really the wealth over a long period of time, because the value of a company is the discounted value of your cash flow, not the profits, right? So focus on cash flows, companies which are generating good cash flows, again, through a better management of your working capital and capital efficiency. So these are the factors, okay, which one would look at, okay, while evaluating a company. And also, I think another dimension, okay, which has really built up out of philosophy is to also look at the management, because I think management is something which is a kind of an intangible, but that really shapes the company and really tests the company during difficult times. And we've seen that good managements who are able to take good capital allocation decisions are able to even pivot their businesses, right, when they go through a certain crisis, or when there are disruptions which are happening in the industry. I think those are the companies which are able to survive, right? And so evaluating the managements, having a framework to evaluate the managements and see which are the managements which can really deliver in terms of the future growth. I think that is also very critical. Okay, I mean, when as a part of a philosophy or a framework, okay, when we are looking at the companies. So I think these are this is the broad philosophy. It's very simple, I would say, right? Most of the players would follow that, but trying to really stick to that, I think it's critical. And then over a period of time, you devise certain things in terms of certain learnings which you have, right? From what you have learned over a period of time, try to see that you don't repeat some of the mistakes. So one big learning for me would be that how to hold on to your winners, right? Many times we identify a good company, it does well, it meets your expectations, and then you want to probably book some gain over there. But when you identify a great company, right, initially you will start with a small position, but the idea is to really hold on to it and ride the whole journey, because that's where you see a big wealth. I mean, that's how what, even in, if you look at my dad, for example, he bought good companies and sat on those, didn't do much, and they became really big multi-baggers over a period of time. And normally when you're very close to the market, there's a tendency to really trade on that, right? Okay, you see the daily prices, and there is, when the stock has gone up double or treble, there is and you have a framework of valuation. But I think one is that not just to be too much hung up on valuations, but really to understand the business. If it's a great business, great management, there's a big opportunity, then you need to hold on to it. And that's where I think you might, because you're not, many times you'll not find very often that you will find great winners, right? So holding on to your winners, I think, has been a big learning, because at times in the early phase, I have actually identified companies early but sold them early, and then we only realized that if I had that in the portfolio, they could have made a big difference. So some of these learnings have also been as a part of our process. I mean, again, it's more about individual, I would say. Okay, how which has shaped the overall investment philosophy.
If you had to list three must-haves in a stock to make it to your portfolio, what would they be?
So, I mean, one is, as I said, growth, because I think that's where long-term wealth. And normally, I would like to have a stock in a portfolio which I would like to own for a long term, right? It's not. I mean, that's the core of the portfolio. So, growth should be better than the I mean, than the nominal GDP growth. When you put it this way, right? I mean, ideally, I would like to have a stock with a growth of somewhere around 15% or so, I think, or thereabouts, or slightly higher than that. I mean, if you can get that, well and good. Otherwise, slightly better than the nominal GDP growth is good, but growth is important. And that growth is not like a growth for the next 1 or 2 years, right? It should be more sustainable growth, because you could always come from a low base. You could have a strong growth for a few years. But when I say growth, these are growth for the next 5 years or 10 years. So that's the first premise. Second is, as I said, the return on capital or cash flow to profits, okay, should be above a particular threshold, right? Because so the cash flow, okay, to profit to cash flow should be at least say 50% or higher than that. The return on capital should be at least say 15%, or at least over a business cycle, right? Should be at least 15%. So that's I think a must, I would say. And so these are I think the three parameters I think which I would look at for bulk of the companies. Obviously, there are certain companies which will not fit this tenet. There are certain cyclical, there are tactical ideas, okay, which will be there in the portfolio. There are companies which are this, especially the new age companies which are coming in right now. So there's a different framework which we'll look at over there. Right there, the profitability and this thing might not really fit the bill at the current juncture. But again, then there you're looking at the whole growth really. What is the large addressable market? And at least down the line, right? It might not be current, but say in our projections, in 3 years, 5, it should be able to at least meet these criteria. So I think there are some of the things which I would look at. And if I have to add something on top of that, is clearly the management quality, right? Again, it's an intangible, very difficult to really this thing, but really one needs to have a comfort on the management that they are like to take the right decisions. More importantly, how the capital deployment is happening, because many companies we see they generate good cash flows. But if they misallocate capital, and if the management does that down the line, and then the premise what you bought that company goes totally for a wrong change, right? So management call it important to the more from a standpoint of right capital allocation decisions. Okay, they made on the cash flows what they then generate.
Sir, coming to the specific funds, some of the diversity funds like ELSS, FlexiCap, Focused, Multicap had faced some challenges but are now bouncing back. They are moving out of the bottom quartile. What went wrong earlier and how tough was it to steer to that phase?
Yeah, so I think in the fund management side, you go through various cycles, right? So it could be because of your philosophy, okay, what you are running those funds, okay, might not be in tune with the current market reality which is there, right? So that is one reason, and that was one of the primary reasons, okay, why some of these funds, right, they were running in a particular philosophy, and then post the like for example the tax relief fund focus more on quality MNC company. We did very well pre-COVID, but post-COVID, when cyclical rally happened, they didn't participate and could not make that adjustment. So clearly, the learning was that you need to, while you stick to your core philosophy, you also need to be aware about the market, right? What the market trends are, and able to appreciate that and make some changes, and also to ensure those guardrails, right? Sticking to the guardrails in terms of you're not overexposed to a particular sector, even if you like that, keeping them within a particular range. You obviously want fund managers to take active bets in the portfolio to generate alpha, but keep them within a guardrails. So in some of these funds, okay, we had deviated from that. Okay, we had taken a slightly larger exposure and not willing to really recognize the market reality and make those changes. That led to a large underperformance in a period. And then we've taken corrective actions. Okay, slightly late, but okay, we took the corrective actions in making those changes over there. Uh, Second, I would say is also trying to, sometimes we fund managers have their biases, right? They continue to have they have biases to a particular stock. So keeping your losers in a portfolio for a long, right, is also one of the reasons. Okay, what we've seen in some of the stocks, okay, which were a drag on the portfolio, and there are opportunities in the market. It's not only a drag, but also you're missing on good opportunities, right? Especially in the market, which is rallying market. And we've seen that in the last post-COVID, it has been a market which has been on an upswing. Only recently, we've seen now again some kind of a moderation over there. So pruning down your pruning down your losers in a portfolio, critically evaluating them, right? And keeping some kind of a price point where you want to reevaluate or to really get out of the portfolio. So I think the selling discipline is very important, okay, and try to build some framework on that. We always know when to buy a stock. And normally, we have a framework to buy. We don't have a framework to when to sell a stock. I think that is another learning, I think, which we have got, okay, when we were evaluating some of these funds, okay, why they did underperform. And we have taken we've taken clearly measures in terms of how do we have the sell discipline in place. We put a monitoring mechanism in place. Whenever stock underperforms, okay, by a particular threshold, we ask three questions, right? One is whether one should buy more, because if you have a conviction, if the stock is corrected by 20% or more, whether you should buy more, or whether we should sell that stock, or whether there's something more data we need to take a decision down the line. But clearly take a call on that and move forward. So and I think overall, I think in the last overall the fund house, we've seen that we've been not able to. We've done well on the large cap side. Mid cap and small cap is an area where we've not done as well. So we have strengthened our research capabilities on the mid and small cap side. We're trying to get more deeper into the companies. We've hired a mid cap, small cap specialist. So that would also help us, okay, in getting some of these funds where mid cap, small cap allocation is higher, and which and that can make a big difference, okay, to the portfolio.
You did mention corrective actions and, bringing in specialists and all. What specific measures or strategies contributed to this recovery? If you can elaborate on that, what drove this turnaround?
So one is that trying to, as I said, putting those guardrails, okay, not trying to be overexposed, okay, in a particular. The first thing, okay, which we did, right, so that you don't. First is to really ensure that you at least come in line with the benchmark. And when there's a large underperformance which is there, the first objective is to at least try to meet the benchmark, right? So that was the first step in terms of trying to ensure that we are not missing out on the large benchmark stocks, okay, which probably are doing well. That was the first step which was there. Then the next step was to really look at, because especially in this market, we've seen that a lot of big macro trends have played out. Okay, and if you're not there early in those trends, you would have missed on the opportunity. So how do we get some of these trends early? And these are not such as sometimes the big sectors; they're some of the smaller sectors. So how do we get early insights into that? So we started having a call with specialists from the industry, experts experts from the industry to give us early insights in some of the trends, okay, which could be there in some of the emerging or the high growth sectors, so that we can catch them early and ride them early rather than being late in that. So that has also helped us to catch up with some of the trends in some of the emerging sectors, okay, which at an early stage. And and then also, as I said, pruning down on your losers in a portfolio, right? So having a clear, not exactly a stop loss, but critically evaluating the drags in your portfolio stocks, questioning them, and then having a corrective action plan, okay, or on some corrective action in those stocks. And these are some of the steps which have helped. And obviously, I think there was some irrationality in the market. I mean, our style and philosophy, okay, of not to chase beyond a particular threshold, okay, was something which impacted us. But I think now the market is becoming much more rational, it's helping us now. So our style also, which was kind of impairing us earlier, is now also in the current market. If you look at the way the market is now, is slightly working in our favor. So all these factors, I think, have contributed to the improvement what we have seen in the performance the last 1 year or couple of years.
Mahesh sir, you also manage the frontline equity fund, which is a large cap fund. So, what's your view on the large cap category? Do you think it can outperform the benchmark over the longer period of time?
So one is the large cap itself, right? So how the large caps, again, in the last 3 years, if you look at it, it's been Nifty, if you look at it, Nifty or the NSE 100, if you take that as the benchmark, that has underperformed the broader market. When I say broader market, means BSE 500, or even take a mid cap or small cap. And so and the reasons for that has been that the lot of money which has came in the retail has gone into mid and small cap funds, even with the AUM, and also FIs have been big sellers, right? In the last 2 years, we've seen, right, and they are primarily in the large cap space, and that has also taken its toll over there. But now, if you look at the large cap or the Nifty, the valuations in the last 5 years, while Nifty also has done well, right, in 2019 to this period, but a lot of the growth in the Nifty is in line with the earnings growth, right? So if you look at earnings CAGR, Nifty returns are more or less in line. So it's not really, I mean, when we say the market has become expensive, that was a talk around, say, 6 months back. So Nifty is like in a fair zone, whereas the broader market had gone up. So if you look at the mid cap and small cap index, there the returns were probably double the earnings growth. So clearly there was much exuberance over there. Now I think we think that there is some kind of a mean reversion, okay, which is, I mean, we see that over a period of time, right? Whenever there is a big divergence, there is a mean reversion, and especially now with growth slowing down, right? And also now there is much more appreciation of risk, right? With huge liquidity, which was there earlier, we saw that risk was getting rewarded disproportionately. I think now the market is becoming much more discerning. And that's where the larger cap companies offer much more stability, right? They might not be the fastest growing, but they are much more stable in that sense. And we're seeing now in this market where now the risk, okay, there's some kind of risk off. We're seeing a broader correction in the broader market. So in this market environment, I would say that the large caps offer a better risk reward. One, because their valuations are relatively much better, right, compared to the mid and small cap space, and in the market current uncertainty which is there global, the larger caps probably are able to withstand much better. So we think that there is now some catch up in the large caps. So relatively, I think they should do better. Now, as a large cap fund, managing a large cap fund, beating the benchmark, okay, the Nifty is critical uh, because you have alternative, right? If you look at the lot of ETFs or the passive money is mainly into the Nifty or the larger cap, right? So that's a competition. So your challenge is to also beat the benchmark, right? The Nifty or the NSE 100, and we've seen that was a bit of a challenge, say around 2018, 19, 20, in that period when the market breadth was very, very narrow. We saw a few index stocks do well. By the end of it, you have to really beat the benchmark. So managing the frontline equity fund, I think the objective is to beat the benchmark. Okay, again, not by a very large margin because that's not possible on a consistent basis, but say by around 100, 200 basis point. We think that's how we are targeting it. And then that's how you manage the portfolio accordingly in terms of your discipline, in terms of how do you construct the portfolio, how do you keep a portfolio with no kind of a style bias, right? Because a style bias can lead to a large outperformance in a period, but it could be periods of underperformance also, which could be there. So I would say that now this is a market also here, which is now becoming more bottom up, right? So a bottom up market is good for a fund manager, right, to pick up stocks and to outperform the benchmark. Unlike in a trending market, right, which everything was moving up. So I think in this period now, a large cap, but within large cap also, if you're having a bottom up approach, I think you should be able to beat the index and generate, say, reasonable alpha. And we've seen that in the last 1 year or 2 years. If you look at a lot of funds, okay, even frontline equity fund had generated around 200 basis point alpha in that ballpark.
If you could quickly mention which sectors look attractive to you in the current market scenario, and are there any areas you feel are still overpriced?
So I think the framework what we looking at sectors, I think is sectors, at least I prefer in this market is sectors which have probably underperformed, okay, for various reasons, where the valuations are not really expensive, and to look at those which you could see a turnaround there down the line. So in that construct, if you look at private banks, okay, they have been big underperformers. Valuations are reasonable. A lot of large banks have not done really much. There's some regulatory I mean, there will be a lot of regulatory headwinds, I would say, which have been there the last 1 year. We think most of the things are now in the price. There's obviously a credit slowdown, but we think it is cyclical. Good time to look at some of the private bank, good quality private banks at this point in time. Then sectors like which have underperformed, like cement, for example, is going through the worst cycle in terms of the EBITDA per ton, which used to be around 1,200, has now come down to around 750, 800. So we are in a kind of a depressed profit scenario, which we think should normalize, because as some demand picks up, you should see that playing on, and commodity prices also, which were, I think, are now starting to ease off. So that's another sector which again we also look at where there's under ownership also, right? The sectors which are under-owned, they are less likely to go down, right? And likely to outperform, okay, when people start to move in. So this is a broader construct, okay, which we look at when we look at the sectors. From that construct, the private banks, the cement sector, okay, could be one of the sector. Consumer, right? Discretionary also has gone through a downturn. There has been a slowdown in consumer discretionary, especially rural consumption has been weak. We're seeing some early signs of that improving, right? Because monsoons have been good, food prices are going up. So rural plays, right? Consumption plays can be a good play. And these stocks have also corrected and there are good quality names over there which you would want to buy from a long-term construct. That's another sector, okay, where we would looking at positively. Among the defenses, I would say pharma still looks good, though it's outperformed. That's not the sector which is underperformed, it's outperformed, but there's still the visibility is good. IT sector, again, from a construct that we are coming in from a kind of a slowdown last year, right, where we saw discretionary IT spends go down because of concerns about US. Now, US growth is not likely to be as bad as is expected. And slowly we are seeing, again, spends in IT starting to improve, and we're seeing a recovery over there. Though this sector has outperformed in the last 6 months, but we think that it offers reasonably good visibility with good cash flows and could be a good defensive in this environment. And also, we're seeing now rupee also being under pressure, right? And looking at the dollar strength, I think, and the fact that we think the rupee is slightly overvalued, there could be more depreciation, okay, which could be there, which should benefit some of these export plays. So these are the sectors where we are constructive. We've also been positive on telecom, which we continue to do so. Also, to some extent, in the industrial and capital goods sector, the sector has outperformed. And I think but structurally, we think it will do well. Again, not really chasing at this price, but any correction, we would look at that sector. So these are some of the sectors where we are positive. We have a positive view from a medium-term perspective.
All right, then it's time for us to wrap up this chat. Thank you, Mahesh, for taking the time for this interaction.
Thank you. Pleasure.
Thank you, sir.